One trade, that's all it took. Not to make a fortune, to erase one. In just 2 days, more than $20 billion vanished. Banks panicked. Wall Street went silent. Some of the biggest financial institutions on Earth started selling billions of dollars worth of stock. Not because the economy collapsed, not because of a war, not because of a recession. Because one trader couldn't admit he was wrong. His name was Bill Hwang. Just weeks earlier, people believed he was untouchable. His portfolio had exploded in value. He wasn't managing millions. He was controlling tens of billions through leverage. Everything looked perfect until one stock started falling. Most traders would have accepted the loss, he didn't. Instead, he held, then borrowed more, then doubled down, then watched everything collapse. Within 48 hours, his empire was gone. Banks lost billions. Investors were shocked. Wall Street learned the same lesson it has learned for more than 100 years. The market rarely destroys you because you're wrong. It destroys you because you refuse to admit you're wrong. And that's exactly why the biggest trading disasters in history all begin with the same 3 words: it'll come back. Every trader has heard the same advice: buy low, sell high. It sounds perfectly logical, almost intelligent, and that's exactly why millions believe it. But here's the uncomfortable truth. Some of the greatest traders in history did the exact opposite. Jesse Livermore made fortunes buying stocks after they had already risen. Stanley Druckenmiller preferred strength over bargains. Richard Dennis built millionaire traders by teaching them to follow trends. Not bottoms, not bargains, not cheap prices. So why has Wall Street spent decades telling everyone to buy low and sell high? Because it's a phrase that sounds good, not one that explains how markets actually work. Think about it. A stock falls 80%. Most people call it cheap. Professionals ask why it fell 80% in the first place. Retail traders see opportunity. Institutions see risk. That's the difference. Humans love discounts. When shoes go on sale, people rush to buy them. When televisions become cheaper, people line up outside stores. Then something strange happens. The same brain looks at a falling stock and thinks, this is my chance. But the market isn't a shopping mall. A lower price doesn't always mean better value. Sometimes it simply means more people want out. The biggest winners in market history didn't spend years falling. They spent years making new highs. Apple, Amazon, Nvidia, Microsoft. They looked expensive again and again. Yet they kept becoming more expensive, which raises a dangerous question. If buying low isn't what created the greatest fortunes on Wall Street, then why does everyone keep repeating it? The answer has nothing to do with the market. It has everything to do with human psychology. And that's where the first lie begins. Bill Hwang didn't begin as a billionaire. He began as an ordinary investor. Then he met one man who changed everything. Julian Robertson, the founder of Tiger Management, one of the greatest hedge fund managers in history. Robertson trained a small group of young investors. Wall Street called them the Tiger Cubs. Some of them went on to build multi-billion-dollar hedge funds. Bill Hwang was one of them. He was brilliant, disciplined, patient. For years, his career looked unstoppable. Then success began changing him. His winning trades became larger. His confidence became stronger. His positions became bigger. Eventually, buying stocks wasn't enough. He wanted more. So he turned to leverage. Leverage is simple. It lets you control far more money than you actually own. Imagine you have $1. A bank lets you control $10. If the investment rises 10%, you don't earn 10 cents. You earn $1. Your money just doubled. Sounds incredible until the market moves the other way. Now that same 10% loss doesn't reduce your account, it destroys it. Leverage is like driving a Formula One car. On the right track, it gets you there faster. One mistake and everything ends at full speed. Bill Hwang kept borrowing, banks kept lending. Because he kept winning, nobody questioned the risk. Success has a strange effect. It makes danger look invisible. Soon Bill Hwang was controlling tens of billions of dollars through borrowed money. On paper, he looked like one of Wall Street's greatest investors. In reality, his empire was standing on borrowed confidence, and all it needed was one crack to bring the entire thing down. The collapse didn't happen all at once. It happened 1 percentage point at a time. One stock fell, then another. Nothing unusual, markets move, that's what they do. But for Bill Hwang, small declines weren't small anymore, because leverage magnifies everything. A 2% loss became a massive hit. A 5% drop became a disaster. Then the phone calls started. Banks wanted more collateral, more cash, more security. This is called a margin call, and it's one of the most dangerous moments in trading. Because suddenly you no longer decide when to sell, the market decides for you. Bill Hwang didn't have enough cash. The banks had no choice. They started selling. Billions of dollars worth of stock. One bank sold, then another, then another. Each sale pushed prices even lower. Lower prices created bigger losses triggered more selling. It became a chain reaction. Within hours, billions of dollars had disappeared. Not because the businesses were worthless, not because the economy collapsed, because leverage turned a normal correction into a financial avalanche. Here's the lesson most traders miss. Bill Hwang didn't fail because he was stupid. He failed because success convinced him the rules no longer applied. That's the trap. Winning creates confidence. Too much confidence creates complacency. Complacency creates oversized risk, and oversized risk always waits for one bad day. The market doesn't need to beat you every day. It only needs one day when you're overexposed. That's why the greatest traders don't ask, how much can I make? They ask, what happens if I'm completely wrong? Because one question builds fortunes. The other protects them. And there's one final lesson from Bill Hwang's collapse that every trader needs to understand. Ironically, it has nothing to do with leverage. It has everything to do with human nature. Here's the part most people never hear about. Bill Hwang didn't lose because of leverage. Leverage was only the weapon. The real cause was something far older. Hope is powerful. It helps people survive difficult times. It builds businesses. It strengthens families. But in trading, hope can become the most expensive emotion you'll ever experience. Imagine, your biggest position starts falling 5%, 10%, 20%. Your brain doesn't immediately say, close the trade. It whispers, wait, it'll bounce. It always comes back. Just one more day. That's exactly how small losses become catastrophic ones. Professional traders understand something most people don't. Hope is not a trading strategy, probability is. The moment your trade requires hope instead of evidence, you're no longer managing risk, you're gambling. The greatest traders cut losses without emotion, not because they enjoy losing, because they understand one simple truth. A small loss is temporary. A catastrophic loss can end an entire career. Think about a forest fire. It doesn't begin as a wall of flames. It begins with one spark. The earlier it's controlled, the easier it is to stop. Trading works the same way. Every legendary blow-up started as a manageable loss. The difference between professionals and everyone else is simple. Professionals extinguish the spark. Amateurs wait until the entire forest is burning. Bill Hwang waited, the market didn't. And that's why one of the largest fortunes on Wall Street disappeared in less than 2 days. Which leads to the final lesson. The lesson that every trader must understand before risking another dollar. Bill Hwang's story was never really about billions of dollars. It was about one decision. The decision to stop respecting risk. That's the moment every trading account becomes vulnerable. The market doesn't destroy traders because they're unlucky. It destroys them because they believe they've become invincible. Think about every legendary collapse. Long-term capital management, Archegos, Jesse Livermore. Different decades, different markets, different people, the same pattern, success, confidence, overconfidence, oversized risk, collapse. History keeps repeating the same lesson. Only the names change. The greatest traders aren't remembered because they never lost. They're remembered because they survived. They survived the crashes, the recessions, the black swan events. Their own mistakes. That's why they were still around when the next opportunity appeared. Most retail traders never reach that point, not because they're unintelligent, not because they lack talent. Because they believe one trade can change their lives. It can. Just rarely for the better. Professional traders understand that wealth isn't created by one extraordinary trade. It's created by thousands of ordinary decisions made with extraordinary discipline. The goal isn't to become rich this month. The goal is to make sure you're still trading 10 years from now. Because time is the greatest edge a trader can ever own. If you protect your capital, time works for you. If you gamble it away, time works against you. So the next time you enter a position, ask yourself one question. If this trade goes completely wrong, will I still be here to take the next one? Because the market always gives another opportunity. It just doesn't promise you'll survive long enough to see it. Bill Hwang didn't lose because he lacked intelligence. He lost because he forgot the oldest rule in trading: protect your capital before you chase your profits. Everything else comes second. If this documentary changed the way you think about risk, subscribe. Because the greatest trading lessons aren't hidden inside indicators. They're hidden inside the stories of the traders who lost everything.